Okay, so the labor market just threw the Fed a curveball. ADP basically came out today and says, yeah, we don't know about adding jobs. In fact, we might be losing them. And then at the same time, on the opposite end of the spectrum, you look at services. The biggest chunk of the economy is still growing. Prices are still hot. Then, of course, there's the people in the back arguing about AI hype and valuations being stretched. But then you look at the US dollar, that's rolling over because the next Fed chair frontrunner loves the idea of rate cuts. So today we got a lot to talk about. We're going to start off with ADP. This is ADP's National Employment Report. It's a big private payroll report built off of private payroll data from 26 million private sector employees here in the United States. And what it shows is that the private sector employment is shrinking in the month of November. Not slowing, shrinking. So ADP says that private employers shed 32,000 jobs in November. Wall Street was expecting to see a gain of 40,000 jobs. We've seen a decline of 32,000. So that's a huge miss. But last month they got revised up to a gain of 47,000 jobs. So basically, you went from this small positive number to the biggest drop since the spring of 2023. Now, normally ADP is treated like this second tier kind of indicator data people get. You get it, you glance at it, take it with a grain of salt, then you go about your day. You wait for the official government jobs report from the BLS, the Bureau of Labor Statistics, and then you move on with your life. But because we aren't getting that Bureau of Labor Statistics jobs report until December 16th because it's delayed, because of the shutdown, we've talked about this like 1,000 times now, that's after the Feds meet. So this time, that makes ADP one of the few hard labor numbers that the Fed actually has in hand going into their December 10th meeting to decide what the heck they're going to do with the rates, instantly making ADP way more important than usual. But the headline, I mean, that was ugly enough, but then you get more into the story and you see that job creation has basically been flat the whole second half of 2025. November's slowdown was pretty broad-based. You come down here to change in U.S. private employment. You see goods producing side, natural resources and mining. Yeah, they gained 8,000 jobs, but then the line below that, construction, lost 9,000. Manufacturing lost 18,000 jobs. Then service providing, information, 20,000 jobs lost. Professional business services, 26,000 jobs lost. So you've got weakness across the higher paying white collar and goods producing side of the economy. You got this usual bright side. Education and health added 33,000. Aging population, you just constantly need more caregivers. And leisure and hospitality added 13,000, which that's your classic people are still going out, having a good time, traveling, eating good, drinking good. So that's a good signal. But then by region, it gets a little bit more messy because the Northeast, it got hammered. That's down 100,000 jobs they lost. Look at the Midwest and the West, they actually did add. And then the South, they lost 43,000. So this isn't just a simple everywhere's collapsing story. The sky's falling. It's more of a choppy slowdown, which lines up with ADP's chief economist and what they said, which is hiring has been choppy as these employers deal with both a cautious consumer and this uncertain macro environment. But the big red flag here is size. And they're always like, Joel, size doesn't matter. But you look at some of these small firms, which make up the bulk of the jobs in the economy, small businesses, fewer than 50 employees, they shed over 120,000 jobs. Let's even highlight this number right here. They lost 120,000 jobs. And then medium firms, those firms, they gained 51,000. Large establishments, they gained 39,000. So small businesses, that's the canary in the coal mine. They don't have access to the cheap funding the way mega caps do, like Apple. They don't have massive cash piles, billions of dollars just laying around. So they also can't float these higher costs onto the consumers forever because you keep on raising your prices because your costs went up. well, they're just going to stop shopping at your store and go somewhere else. So when these small businesses start cutting, it's usually because something is pressuring demand or even margins. And that's what we're kind of seeing. ADP's economist is literally calling small firms the canary. And this is now the third time in 4 months that private employment has gone negative. So, big picture overall, the labor market, it's not in this 2008 style free fall. Layoffs aren't exploding, but hiring is clearly in our face downshifted. And we just got the weakest print since back in the pandemic period. And remember, what the Fed cares about. They've already said this and talked about this, and we've talked about it here, but they've already cut rates twice because they were scared of exactly this: a slow burn weakening in the labor market that shows up as slower hiring, then higher unemployment, then pressure on growth in the economy. So ADP's print gives the camp at the Fed, the friendly side of the Fed that wants to cut rates, more support before their meeting. And you see this in the CME Fed Watch tool. So the expectations are now at 89%. Markets before this ADP report came out, they already, another cut's almost a done deal. And then ADP's negative jobs number is just pushing that conviction even higher. So now we're at 89% chance expected of a 25 basis point rate cut. And now you flip over to ISM. This is another big piece of today's macro story. This is services. This is a giant side of the economy. It's made up of banks and retailers and healthcare and hospitality and real estate. It's a huge chunk of GDP. So the ISM services PMI, that's a monthly survey where executives say whether business is doing good or if it's getting worse. It came in at 52.6 in November. Now, for context, anything above 50 is expansion. So that's good. That's a good number. And this is the 9th time this year it's been in the expansion territory, and it's also a 9-month high. So while ADP's telling you hiring is shrinking, services are telling you business is still growing and it's actually doing pretty good. And that's the tension. And it kind of sounds like stagflation because the economy is not dead. It's just getting more uneven. The labor market's slowing down, especially for the smaller firms that make up the bulk of the jobs. Then prices are still increasing in a sticky space, and services, a huge chunk of the economy. Now let's break down the services report. So business activity index, this increased, it's now at 54.5. Solid expansion. Capital projects are at an all-time high in some of the comments mentioned. Then you look at new orders, it's at 52.9. Still growing, but it did slightly decline from 56.2 as these customers are more cautious committing to new work. Employment came in at 48.9. So that's actually in contraction territory. So, and that's also in contraction territory for the 6th straight month. Slightly better than October, but it's still below 50 as these companies are filing vacancies. It's not aggressively adding new headcount though, so jobs just still aren't hiring. And then you look at prices, 65.4, still very high. It's the lowest in 7 months, but the index has been above 60 for pretty much the full year. And that is persistent service sector inflation showing sticky. So, I mean, you're looking at this services side of the economy and it looks like growth, but slower growth. Hiring, but it's selective hiring, and prices, those are still hot. And executives are saying that tariff uncertainty is really messing with their decision making, messing with purchase decisions. Some industries like retail and arts and entertainment and food services, healthcare, they're doing well. But then you got these other sectors like construction and real estate and transportation and management services. They're all showing to be in contraction and talking about affordability problems and mixed signals and squeezed margins. So it's for sure uneven out there. But then you put ADP and ISM together in the story, well, it looks like this jobs engine is sputtering, especially for these small firms and cyclical sectors. The services economy is expanding, but hiring is cautious and prices remain elevated. Tariffs and the shutdown show up everywhere now in delays, in costs, and in uncertainty. And that is exactly the kind of backdrop the Fed will say, well, we don't want to crash the economy, but inflation isn't dead either. So they just got to kind of pick a side. Now, let's talk about AI for a second because this hit market sentiment early today. This is the information piece that was reported on Microsoft. I don't have an information um, subscription, so we're reading it here on Barron's, but they pretty much talked about easing sales quotas on its enterprise AI products like Microsoft 365 Copilot. I don't really like Copilot very much. I don't really like Microsoft very much. But the market read that as, all right, maybe enterprises aren't adopting AI at the speed we thought. So it's overhyped. Let's sell. And then later on in the day, a Microsoft spokesperson then pushed back and said aggregate quotas, they haven't been lowered. So we don't know where that came from. But the fact that this kind of story moved the markets the way it did, it really tells you where we are in the AI cycle. There's tons of excitement still. Not a lot of clean disclosed revenue yet, though. That's kind of the problem we're heading. And then the Census Bureau's Business Trends and Outlook survey, what that said is about 10% of businesses used any form of AI in September. That's up 3.7% 2 years ago, but from 2 years ago. So adoption, it's absolutely grown. You can't deny that, but we're still pretty early. It still hasn't boosted productivity like in a crazy manner yet. But the survey says adoption among bigger organizations actually declined over the summer as some of these firms backed off pilot programs. So you got equity valuations, they're screaming AI boom, AI to the moon, let's get rich together. And then real world adoption, it's still single digit to low double digits. And companies, they're quietly testing, slowing, or even tweaking how they roll out stuff now. And now you overlay that with profits, the S&P 500. It's at about its PE ratio, price to earnings ratio, is at about 30.4. Now, historically, that's rich. And forecasters expect 13% EPS growth, earnings per share growth in 2026. And that's the denominator of the price to earnings ratio. And almost all of that bullish narrative assumes that those profits just keep marching higher. But then you've got a catch. A lot of that profit strength has come from huge fiscal deficits, heavy investment, debt-funded shareholder returns, them lighting money on fire. So if households begin to get nervous about this AI story and AI taking jobs, and then they start saving because AI is going to take my job and then I can't get a new job, that's less consumption. And the Kalecki levy framework that says basically this: if the government spends less and then also households save more, corporate profits feel squeezed. And then it's just back to price to earnings, and does earnings growth continue rising exponentially forever? But on top of that, AI CapEx, it's pretty expensive. You got these data centers and then chips and then infrastructure. They're massive cash burns. You're lighting money on fire. You're pretty much taking today a trust me, it'll pay off later story. And some tech giants, they're even cutting or slowing dividends to fund it. So you can absolutely have a world where CapEx goes up, reported earnings growth slows or even begins to disappoint, and then the market suddenly realizes this 30 times multiple assume a cleaner profit story than reality delivers. So it might not be as good as we think. And that's the risk sitting under AI and valuations right now, and what a lot of people are worried about. But then let's bring the Fed chair drama back, because this feeds straight into the US dollar, the United States dollar, the reserve currency of the world. So the Wall Street Journal dollar index has been dropping for 7 straight sessions in a row. It's on track for its longest losing streak since mid 2020. Now, one big reason is that people are seeing it looks increasingly like President Trump's going to pick Kevin Hassett as the next Fed chair. I think they kind of backwalked that a little bit, but we're still talking about the news as it progressed today. Now, Hassett has made it pretty clear. He favors lower interest rates. He's publicly said he'd be cutting now and has spoken positively about a 50 basis point move in the past. So if Hassett is placed, we know he's a Trump yes man. We know he wants to cut rates and he wants to get closer to that neutral rate, which he sees lower than some of these other Fed officials. So why did that hit the dollar? Well, let's think about it. So in simple mechanics, lower expected US interest rates, lower yield on dollar assets. And then lower yield equals less incentive for global investors to park money in, say, these US treasuries or dollars in the terms of cash. And that reduces demand for dollars. And dollar weakens versus some of these other currencies in a basket pair. And if markets think that the institutional mindset of the Fed is shifting from inflation fighter to this growth booster, that can anchor inflation or unanchor inflation expectations over time. Now, we're not there yet, but 5-year break evens are still closer to the low twos versus the 3%, but that's exactly what some economists and strategists are watching. If those expectations start creeping towards back, say something like 3%, bonds stop being this safe stabilizer they're supposed to be in a portfolio. And it makes sense. If inflation expectations unanchor and you think inflation is going to become more of an issue, well, assets perform usually well under inflation. So you're better off getting rid of your dollars and trading your dollars for assets. I'm not recommending you do that, but that's just kind of the psychology here. If you remember back in 2022, both stocks and bonds sold off. And that's what happens when inflation gets sticky and the central bank is behind this curve. And a Hassett-led Fed that leans hard into cuts with inflation still above their 2% Fed target, that's where the risk begins coming back. So with all of this that's went on, markets digested this, and we started off the day with that Microsoft AI headline from the information, softer sentiment, stocks opened a little bit weaker, but then they climbed throughout the day. They climbed throughout the session. So by close, you had stocks with the NASDAQ. This one closed up 0.17%. You look at the S&P 500, this one closed up 0.3%. It was really a choppy day though, a lot of consolidation. I was trading, I was getting the puts in at the top of the chart, at the bottom of the chart, getting the calls in. Look at the Dow, 0.86%. And I'm pretty sure you can look at one of my videos. I said the chart just looked a little sketch, and look exactly what happened. So not saying I predicted the future, but it's recorded. You look at Bitcoin. This one was down when I started the video, but it was down 0.6%. Now it's up 0.15%. So Bitcoin's all over the place, but that was after a nice strong move yesterday where it was up 6%? I don't even remember. So the market takeaway today, it's basically ADP equals more Fed cuts likely. Maybe even in January, people are pricing that in now. ISM services is still in expansion. There's no immediate recession then. Hassett odds are rising, even though they kind of backtrace that, and now we don't know who it's going to be until February or March. That's a more dovish Fed path, though, with the Hassett odds rising, which equals a weaker dollar. And we just kind of talked about the psychology behind that. People are going to end up trading their dollar. Now, we don't know what's going to perform well because back in 2022, bonds and stocks sold off. And then AI, Microsoft, and the stock market valuation worry. There's some cracks in the everything AI touches turns to gold story, but it's not enough to derail the broader risk on mood yet. So investors are still buying the soft landing with a dovish Fed narrative, even as the micro data, the small business, job losses, cautious hiring, tariff noise, sticky services prices, it says the economy is getting more fragile under the surface. So that's kind of where it puts us today. The labor market, it's weakening. It's not broken, it's just weakening. It's slowing down. The services sector, it's growing, but with elevated prices and cautious hiring, the AI story where hype is ahead of adoption and profits might be more fragile than the price to earnings ratio suggests. The dollar's weakening as markets price in a cut-friendly Fed and possibly a new Fed chair who loves lower rates. Remember, he's a Trump yes man. And stocks grinding higher anyways despite everything. sitting on expensive valuations powered by an 89% implied chance of a December cut. So whatever the Fed does next and whatever the next data print looks like or whatever the next breaking news article is, we'll keep breaking it down here, everything going on. I appreciate you watching this video, hanging out with me. Man, we've came a long way together. So I appreciate you. Thanks for tuning in. Like and subscribe. I never say that. Let me know you like these videos. Comment something. Help a brother out. But you have a good one.